What's going on, guys? Welcome back to the channel. We have some very important information to share with you guys. That data does show that we could be very close to the Moas. And before you guys comment down below, this is not clickbait. We're going to be going over the data behind this, and I want to get straight into it and not waste any of your guys' time. So hit that like button for me, consider subscribing to the channel, and share this video if you find this information insightful. I don't think there's another video, or at least one that I've seen, that is going over what we are going to talk about here in this video. So make sure you guys share the video, comment down below. Most importantly, let me know your guys' opinions on this. Does this make sense to you as well? Now also check out the pinned comment for the link for my Twitter account if you guys want to go follow me over there, and the link for the buy and sell alerts. It could make you guys a bunch of money if these events that we're going to talk about here in this video do pan out like I think they could, or the data does suggest that they would. Now let's talk about it, guys. And first off, when you are thinking about the Moas, why hasn't the Moas happened? This is one of the most frequently top asked questions in the community. Now it has nothing to do with what happens to AMC's share price. AMC could go to $200 or $300 per share and you would not see the shorts be forced to cover on a mass scale. And really, I should kind of rephrase that. Right now you'd see more shorts that would be forced to cover because the markets have went down. That cash pile that the hedge funds are sitting on has to go in to service their margin calls that their portfolios are seeing or soon to be seeing. So point is, the whole time throughout the history of AMC, the stock market has been hitting higher highs. The one thing that will cause the Moas ultimately is one, when AMC does start to rip, but when the liquidity is dried up. And that has not happened this whole journey with AMC, and we're starting to see the first signs of this happening. And that's why this data is so very important. So that's the main reason why the Moas has not happened. There's too much cash out in the stock market right now. And to prove this for you guys, we seen even during this June rally, we went from about $9 per share all the way up to almost $80 per share. Guess how much of the short interest was actually covered during this time? We went from 19.94% short interest to 14.71% short interest. That was only 5.2% of the short interest was ever covered during that rally. If all of that short interest had been covered, we would have went to hundreds of dollars per share. Now we are back up to these extreme levels, and I personally believe the short interest is well over 20%. Shorts have effectively been digging their own graves. Now let's talk about how we are actually, I think, getting close to the Moas. What kind of data suggests this? And the best way to try to figure out what will happen in the future is to look at the past. And this is where this video is going to get incredibly important. We have to take a look at the federal interest rate. This is the federal funds effective rate. This is essentially the rate that banks charge each other to lend and borrow money. So this has obviously a direct role into what you pay when you go and get loans for things like cars, things like houses, or just SBLs, right? Securities backed loans. It affects everything. Now, what happened since 2016, they started to raise interest rates all the way up until the end of 2019, and ultimately back here in March and February they cut rates down to zero, going from about zero in 2014, rose these rates all the way up to about 2.4%, and then back down to zero again. You guys can see the long-term, since about the 80s, the rates have been constantly going down, intervals where they will go up and then they will go down based off of inflation and how the overall economy is doing. Now, to understand why that is important, you have to take a look at the overall markets. And during this time, from really 2018 through 2019, when you've seen all those rate hike increases going from 0 to 2.4%, that was a big deal, and you've seen the markets sell off over an extended period of time. We've seen the markets back here January 26, 2018 take a downturn and did not fully recover until September 21st, 2018. That was 8 months before the stock market ever returned to its highest levels. So right there, if you have short positions, if you have, interest that you have to pay on your positions, if you're a hedge fund, that is ultimately going to kill those positions. But then what happened in 2019? You've seen the rates continue to go up at an even more aggressive pace, and look what happened to the marketplace. This is where you are vulnerable for short squeezes. And like I said, and we talked about in the last video going over Volkswagen in 2008, Volkswagen short squeezed at the very bottom of the markets. Back here, October 2008, this was literally the bottom of the markets, and it wasn't just Volkswagen. It was a lot of other stocks. Volkswagen went up about 500% in about 3 or 4 days. So that caught the headlines. But like we went over in the last video, there was tons of other stocks that were going up 50, 80, 100% on any given day. And that's when you're really vulnerable for short squeezes, when you don't, or I should say, when hedge funds don't have enough money to service those margin calls. Because we all know, I hope this is not a huge surprise, hedge funds and institutions that have short positions on AMC, they don't have a large allocation of their portfolio invested in these short positions. We're talking about possibly hundreds of hedge funds that have maybe a quarter of 1% each of their portfolio allocation in these short positions. So to see the stock go to $100 per share, it doesn't really move the needle in a substantial way for the hedge funds. If they have $50 million, they can go throw in their margin account. That will service their margin call. They won't have to cover it until the stock comes back down, and then they can do what they want. Hopefully that makes some sense, you guys, why the Moas has not happened and how interest rates play into what happens with the stock market and how that leads to more short squeezes. I think that is pretty much straightforward. Now we're going to get into something else, because we do have the Fed meeting December 14th and 15th. Most people, I don't really think anybody is projecting them to actually raise interest rates on this December 14th and 15th meeting. I do think it would make sense to start to lean towards that. I'm not saying I think that's actually going to happen, but I do think there will be some hawkish verbiage around raising interest rates. Hawkish means more restricting of money, more we need to raise interest rates, we need to start tapering faster. I think you're going to get a lot of that communicated to the markets. And even if Fed Jerome Powell doesn't announce interest rate hike increases in the near term future, even just sounding too hawkish will send the markets into another spiral. Now we are expecting to get faster tapering, and that is probably widely priced in at this current moment. We could see another sell-off based off of that, another 3 to 7% downturn wouldn't surprise me in the markets if he did announce that, because that's a new catalyst, right? That's something we didn't necessarily know about. But if he's more hawkish, if he does announce something with interest rates, you're going to see the markets go through a downturn. Obviously, AMC would get beaten down in the short term. Probably, if I were to estimate, like I said in my price prediction video just today, maybe $20 per share. That's probably the lowest level I would think AMC would go. And then ultimately, you will see shorts having to cover on their short positions to break the piggy bank per se and get their collateral out of their short positions, because you can't short a stock without having collateral to back up that short position. Now, ultimately, why do I think that Fed Jerome Powell could announce something that we don't know? Could announce maybe raising rates faster or a faster tapering that would send the markets down. It is due to the fact that we have a lot of data suggesting, and even Fed Jerome Powell said he is retiring the word transitory. They think inflation is going to last a lot longer. Other than that, though, we have actual data that does suggest inflation is going to last a very long time, possibly for years into the future. And the Fed, they have tons of knowledge on this. We only get a fraction of the knowledge that the Fed actually has. But for November, we only seen the U.S. gain 210,000 jobs. Wall Street's estimate was 573,000 jobs. This was a huge miss. And this just shows you guys that wages are going to start going up. We didn't see that actually come out in the report, but it's inevitable. If you don't have enough employees, if there's so many jobs that need filled and they're willing to hire for a higher price, people are going to take advantage of that, and everybody's going to have to raise the amount that they pay hourly or for a salary. So that's a key point of this. As well as that, you have inflation at about 6%. And this is only going to get worse. Let me pull up the reverse repurchase, the repo market for you guys. Because we can see all of this money has really started to balloon since February 2021. And really at about April, you start to see this go crazy, going from $30 billion all the way to where we currently sit at about $1.5 trillion. And what is this? So this means there is too much cash out in the economy at the current moment. $1.5 trillion of unused cash that these banks have to get off of their balance sheets, or potentially either too much cash or they need safe collateral. And I don't see this number going up too much, so I don't necessarily think at the current moment it's a rush for safe collateral. It's just there's too much cash out in the marketplace. A lot of this is being parked by other companies as well. Me, Kevin, made a video about this, and a lot of people have actually talked about this, but when you buy all these treasury bonds, when the Fed has bailed out all of these losing companies in 2020 during the height of the pandemic when the markets were crashing, and those companies have actually rebounded and started to do much better, like Ford. They were considered a junk bond in 2020. There was a decent risk of Ford going bankrupt. Ford paid about 9% on a bond. That is ridiculous in this current day and age. So take that into consideration. You've seen what has happened with Ford. They got all this money. They didn't necessarily need it. So all of this money that has been pumped into the economy is going to take years for these businesses to spend and really to get out into the overall economy. So when you add all of this together, I think the Fed knows we're in for higher inflation next year and possibly 2023 as well. If you're thinking 6% inflation is high, we could possibly be at over 10%. At that point, if the Fed predicted we would be at over 6% inflation next year too, I think they're more inclined to act at least a little bit more hawkish to try to control inflation. And ultimately, once you do start to raise rates, that's when you see the market going down, like I said. But on top of this, guys, we see margin levels that are insane. Think back to what we just said. When the Fed raises interest rates, what actually happens to the margin levels? In 2018 and 2019, they started to raise very aggressively. The stock market sold off. Look at the margin debt, back and forth action. It really didn't move around too much in 2018 and 2019. It hovered in between, 550,000 and well, really in between about 645,000 and about 665,000. Billions is, hopefully you guys get what I mean. But when you go to 2019, when the markets really started to sell off, you still seen a tight range of this margin debt in between 554 billion on the low end and 602 billion on the higher end. Very, very small fluctuations. But now take a look at 2020. You seen that low in March, 479 billion dollars. That was the lowest level. Ever since then, we have been constantly climbing. Now we are almost double what we were at during the crash of March 2020, with almost $1 trillion of margin debt. And that's not even including SBL loans, security-backed loans. You can go to the bank, get a loan on your portfolio instead of selling your stock. That's what a lot of rich people do. Those loans are estimated to be in between $250 billion and potentially as high as $500 billion. So when you include the margin, you include that, you're well over $1 trillion of total loans on stock portfolios. This will compound the losses once it eventually does start to topple over. Now, I don't want to sound like a huge bear here, but it's definitely on the cards. And if these events happen, if we get a hawkish Fed Jerome Powell the 14th and 15th, I do expect to see the market downturn, AMC to go down in the short term, and then to see the Moas couple weeks after that. That is what I would expect to happen, just like we seen in 2008, just like we see with the federal funds rate. When that goes up, stock market goes down, direct correlation. So that's going to be all for this video. Hopefully it gave you guys a lot of good information. Hopefully it made some sense to you guys. If it did, consider sharing this video, consider subscribing to the channel, like the video, all of that good stuff. More importantly, let me know down below in the comment section, do you agree with this? Do you disagree? What do you agree? What do you disagree on? That information is very, very valuable. Also, like I said, check out the pinned comment down below in the comment section. So that is all for this video. Love and appreciate you guys. Thank you for supporting this channel. I'll see you guys in the next video.